All right, welcome to the Interaccess channel today. I want to talk a little bit about one of my favorite subjects, believe it or not. When I talk about crypto and alternative assets and such, I think the area that is available for the most upset, the most disruption in the financial services industry is insurance. I think this is most ripe for disruption, and I think blockchain technology, crypto, DeFi is there to do it. And let me explain to you a little bit about why. First, we have to go back and talk about what insurance is, right? Technically, insurance is a pooling of risk, right? A bunch of us put our money into a pot, essentially, such that if something bad happens to any one of us, this is the origins of insurance, right? Mutual insurance. If something bad happens to any one of us, the money that's in the pot goes to that person, that entity, whatever it might be. This is the essence. This is the origin of insurance. And now what we have is insurance companies, right? Because insurance companies have had to get better and more efficient. And the insurance companies create these pools of money and they say, you, Adam, you're going to pay this premium, right? We've gone through some sort of underwriting. So let's say, in this case, it is life insurance. Adam, we have gone through some sort of underwriting. We've decided here's the premium you have to pay to get a certain death benefit. Should you die, here's what your families will get. And all these people are paying premiums into this pot. Now, the insurance company, of course, has to manage this pot of money such that they've done their actuarial calculations. They've figured out how many of their insurance policyholders are going to die every year, statistically, and they have to have enough money to pay all of them out. And what happens is this pot of money, not only does it sit there and is used to pay out, because the money doesn't just come in the door and go out the door, this money gets invested. Okay, and when I say invested, it sometimes can get invested in bonds. Of course, in the last 15 years, that hasn't done very well. So it has to get invested in equities markets. It has to get invested in all sorts of other investments out there, because the company is doing their calculations. They have investment managers, and they're trying to make sure that they have enough money to pay off to pay all their policyholders that die. In this case, if it's insurance for my house or my car, same thing. They do the underwriting, they do the actuarial calculations, they figure out what are the chances that something happens to Adam's house or Adam's car. And as you well know, if you've owned a home or owned a car, that those insurance premiums can change wildly based on where you live and what kind of car you drive and what kind of house you have and what the roof is like and all of those things. And there are certain areas of the world, certain areas of the country where you can't get certain insurance. If you're in certain places, you can't get flood insurance or hurricane insurance or something, because it happens so often that the insurance companies have actually had to pay out more money than they've taken in, because there's no way to take in enough in premiums to pay out the monstrous claims that they have. So this insurance could also be something like crop insurance, meaning if I have a farm, I might buy crop insurance to say if this is a really bad year for weather, if it's too rainy or if it's too dry and I lose my crop, I need to somehow get made whole. That's what insurance is. I am offloading my risk onto a group or onto someone else, because the negative that can happen is so negative, it's so bad for me financially, that I then have to be somehow made whole. And I'm willing to pay some amount such that if I have that really bad financial experience, then I am made somewhat whole and I can sustain myself and my family, or if I've died, my family can sustain themselves. That's the whole point of the insurance. So this is how the system works. Now, remember, you and I do not usually have purview into what's happening in the actuarial process and the underwriting process. We don't get to do that. You and I also don't get to participate in the growth of this fund, right? This fund, this pool of money is there strictly to pay out claims, and then the insurance company can earn on it, and they earn a lot on it. They have a lot of money there that they earn interest on, that they earn growth on, whatever it might be. And as long as they've made the right calculations, they're not going to run out of this anytime soon. The other part of insurance is, as I said, depending on where you live in the world, it has to be financially beneficial and economical for the insurance company to have to actually offer certain types of insurance. So if there are only a few farmers in a particular area, it doesn't make sense for a large insurance company to go through the time and trouble of making actuarial calculations based on the weather in that particular area and offer insurance to those farmers. So there are all sorts of issues with the insurance industry. I'm not saying they're necessarily bad, but these are issues that come about because of economics, because of finances, because insurance companies have to profit as well. They're usually for-profit companies, and they have to figure out how to profit. They have to figure out how to not run out of this. And if they are in an area where they are going to run out of this pool of money and not be able to pay off the claims, they can choose to either charge higher premiums or just cease to offer the insurance altogether. So that's why I think crypto and DeFi and Web3 and everything can upset insurance. Let me explain to you how that works, because it can happen in multiple different ways. There are multiple different ways that insurance can be disrupted through this technology. And one way is since crypto and blockchain is so much more transparent, we can create these little mini pools of funds. So if there are, say, farmers in Africa or something, and there are only a few of them, and it wouldn't be worth it for most insurance companies to try to, provide insurance for them, you or I or, a few of us can go through the calculations and figure out what it would take to go ahead and offer insurance to those farmers. We can go through the weather calculations. We can figure out what it would take for how bad the weather would have to be. We can look at weather patterns, whatever it might be. How bad would the weather have to be for them to have a claim and have to be made whole? And we can potentially offer insurance to them. We can say, look, here's the pool. You guys can all put in your premiums. And by the way, while the money's in there, we get to go invest it. That means you and I might want to put some money into this pool, because so long as we've done our calculations correctly, we might not have to pay out a whole lot of claims. And if we do that for a few years, if there aren't claims for a few years, this could build up a sizable amount of money, and we've potentially made our investment in it, right? So now, because of the decentralization, because I can create a on-chain pool that is more efficient. And why is it more efficient? Because it doesn't have to be huge. It doesn't have to be a big company. It can be one or two of us that is able to do the actuarial calculations and launch it. And again, because it's potentially on-chain, meaning it can accept payments in things like stable coins like USDC or USDT, it means we don't have to go through typical payment rails, meaning we don't have to we don't have to pay a lot of money to have them to have that money move around. We don't necessarily have to set up bank accounts everywhere. It could just go into this pool. We can also have a lot of the claims process automated through what we call oracles, which says, maybe this says, okay, we're going to check the weather, we're going to check the rain, we're going to check the wind, we're going to check all these other factors, and we're going to do it on weather instruments that are all over this area. And if they hit certain readings for a certain amount of time, it's going to trigger these claims to be made. And if not, then those claims will not be made. And by the way, the farmers will be really happy, because that means their crops are growing just fine and they're making money, right? So we can automate so much of this because of smart contracts, because we can invest in this, because premiums can be paid on chain, because the pools are very transparent. We know what's in the pools. These pools can then be invested in certain protocols, certain lending protocols, such that they can make some interest. But it's also very, very liquid, meaning if we ever have to get the money back into this pool and pay out claims, we can do that immediately. Again, it's very transparent. So that's one way that we're going to see insurance be disrupted by crypto and Web3. It's that we are going to be able to offer more insurance products to more people in the world that need it, because of the transparency and efficiency we see in blockchains. The other part, as I mentioned, is maybe you and I, maybe we, and I'm seeing this already with, say, health insurance in the US, it is maybe we're going to take a more active role in our insurance, right? So maybe we can create our own insurance pools, or maybe a company can create a pool to fund healthcare. So maybe we don't call it health insurance because insurance, of course, is highly regulated. So maybe we call it a pool of money, and a whole bunch of us are putting in money to this pool, and we can go into details about how those calculations are made, about how much money I have to put in, and maybe it's based on my family, maybe it's based on my health, maybe it's based on where I live, or my lifestyle, something like that. But I can put money into this pool, which is essentially what health insurance is. And if I never have to go to the doctor, then that's fine. I'm still paying my amount into the pool. I'm not going to call it a premium because I'm not going to call it insurance. And then at some point, all these people are putting their money in. And if one of us has a claim, the claims process can be very transparent. I send in my claim. I went to the doctor. It cost me $250. I need to be paid out, and money comes out of this pool. Meanwhile, this pool can also be invested in some sort of protocol, lending, or whatever it is. But again, all of us have purview into this. All of us can see because of the transparency. And if anyone has gone through trying to find health insurance recently, the prices have gone up because what doctors and hospitals and everything charge has gone up. But this is a way to kind of take some of that control back and go, look, I'm a healthy person. I don't want to put that much in. I will take the risk that if I do have some sort of claim, that this pool is going to have enough money in it to go ahead and pay out my claim. Now, that sounds an awful lot like health insurance, but this is going back more to the roots. It's taking a lot of the fat out of it. It's allowing for me to have a lot more control over my health decisions, over my medical decisions. The other part of this is, let's just say that we as a group do a really good job of vetting who gets to come into our little pool, because oftentimes when people are investing, when people get health insurance, it's not because I need to pay for the health insurance for me to go to the doctor. It's more because I need the insurance there in case there's an accident, in case I have to go to the hospital, in case there's a $10,000 or $20,000 or $50,000 or $100,000 bill. That's really what the health insurance is there for. It's not there as much for my regular doctor's visits, and that's why most health insurance actually completely funds your annual doctor's visits. So let's say we've done a really good job of determining who can come into our pool and that they are in A+ health, right? A+ lifestyle. Maybe others want to come invest in this because we're able to take this pool and invest it really well, and it gives different options. You and I and your clients and others are going to have the opportunity in the future, I feel, to invest in insurance pools, because insurance pools do a pretty good job of earning money, because you can go, look, I can look at the transparency of this insurance pool. I can see what kind of money is coming into it. I can see what kind of data, what kind of claims it's had to pay out. I can see how they're doing their actuarial calculations. I want to invest in this pool, and by investing in it, I might get a piece of the premiums. Therefore, these people that are paying into the pool don't have to pay as much because someone is willing to actually invest in the pool. And as this pool gets invested in various protocols and tries to earn interest and grows, I, as the investor, get more money out of it, because we've done good, transparent calculations. We've done a good job with our pools. This is going to be the same with homeowners insurance, with all sorts of, with auto insurance, with all sorts of other property and casualty insurance. You and I are likely in the future going to have the opportunity to invest in them, because these pools are going to be more transparent, they're going to be more open, and they're going to want more investors. And having more investors in those pools, because of the transparency, because of the efficiency, because eventually I'm going to be able to connect my wallet and invest into it, that transparency is going to mean the premiums don't have to be as high. Because if I can invest in this pool, then those that need the claim, those that need the benefit, don't have to pay as much into them. Okay, this is just another investment I'm going to have in the future. So as advisors, understand that, one, I think insurance is definitely in need of disruption. It's definitely going to get upset. And this is how we're going to do it. We're going to create some of these smaller pools, smaller companies, smaller protocols, whatever it might be, because we have the technology to do so now. So again, you and your clients are going to have different opportunities when understanding your insurance needs. Their insurance needs are going to be different options. We're already seeing this with health insurance. We've already seen it with things like crop insurance. We've seen it with little binary things like flight cancellation insurance. If my flight gets canceled, I get my money back. We see that in insurance happening within the crypto blockchain DeFi world quite often because it's really easy. Either your flight got canceled or it didn't. There's not a lot of nuance to it. Some of these others, there is some nuance. Did the crops get enough water? Was there enough rain? Was it too dry? Did someone, lose all their crops? There's a little bit of nuance to that. So we're going to see more options for how we insure things, how we insure our business, our life, our homes, our property, whatever it might be. And as advisors, you're going to have to understand that. Going to have to understand these different investment options, right? The option that your clients at some point are going to have the option to invest in insurance pools. Those are going to be investments in the future. And you're going to have to understand how those work, how the transparency works, and how to put those into a portfolio so that your clients can earn more income. And overall, you're going to have to understand that the insurance company is likely going to get upset. Now, they're not going to do it willingly, but we're going to, I think, in the world, see more products that look and feel a lot like insurance. They probably won't call themselves insurance because of the regulatory issues, but more products, more offerings, more services that look and feel a lot like insurance. And what we're going to see is just pools of DeFi, of decentralized money, right? Pools of money from investors that eventually get invested in some of these insurance options. Okay, so that's going to be an option for something like treasury management. They're going to get to invest in this. We're also going to see companies, that are virtually on chain, that are dealing with things like oracles, that are dealing with things like data management, get into kind of the insurance business and say, we're going to use our data management, our transparency, our ability to track what's happening on chain and start offering some sort of coverage protocols. I think that's what we're going to see in the future. I think insurance is an industry that is definitely ready for some disruption. And I think the blockchain technology, crypto, Web3 is there to do it.